Welcome back to the podcast, everyone. My name is Pyotr, and we are joined today by Dana Samuelson, someone who has been in the precious metals market for over 4 decades. He's the founder and president of American Gold Exchange, former president of Professional Numismatists Guild, and a very consistent voice, someone who's been of interest to me around monetary instability, debt, geopolitical risk. As you know, on the Global Gambit, we like to converge the nuances of international relations, geopolitics, economics, and put them into contemporary developments. And well, we've had some big developments in the past 24 hours. Trump suggesting that peace talks were possible and there would be a drawdown. But at the same time, we've had reports that the 82nd are going to be going to the Middle East. So it seems a bit of inconsistent messaging from the White House, as per usual under this administration. But Dana, from an economics perspective, markets perspective, we've seen some reassurance, and then prices went up again and down. So how do you look at things at the moment?
Well, thanks for having me. I'm glad to be here with you. I'm concerned about values for equities right now. I think they're going to be impacted by higher for longer oil prices, which is inflationary, of course. I'm a little concerned that we've gotten a head fake from President Trump yesterday with his announcement that, we're pausing the Iranian energy attacks for 5 days, because conveniently that's going to give those 3,000 troops enough time to arrive in the Middle East where they need to be positioned if we're going to go into a ground war of some kind, which is what the tip of the sword is about with the ground troops coming in. So we'll see. The longer this conflict goes on and the more Iran can attack its neighbors around the Middle East, specifically the energy production facilities, the worse the economic downturn that we're going to see is going to be, because of the higher energy inputs that this is going to create for the rest of the world. Some countries are more affected by this than others. China has a pretty good reserve of energy, about a year's worth, while Japan is much more vulnerable. So is the Philippines and Thailand and Vietnam, because they don't have those reserves. India is particularly vulnerable as well. So it's a question of how many reserves you have and how much cash you have to buy new ones with. And some countries are just more challenged than others in that regard. The U.S., is pretty well insulated because we're, allegedly energy self-sufficient, which we pretty much are right now, but I don't know if we will be for decades to come or years to come. But I do see this conflict as being, it's going to end sooner rather than later for political considerations for President Trump, because, the higher gasoline and energy prices go and they stay higher for longer here in the U.S., the more it's going to impact the economy, the more it's going to impact his reelection chances come the midterms for the House and the Senate. And keeping control of Congress is paramount for him to continue his agenda for the second half of his presidency. And I think that's really where the biggest political calculation he has will be. And of course, that's different than what Israel wants in this conflict, which is to completely eliminate the threat that Iran poses to Israel. So there's a whole lot of variables going on, and we'll just have to see how it goes. If we put troops on the ground, that could be a longer, more protracted conflict, depending on how it goes.
Yeah, I think it's a good point to emphasize about the distinctions of strategic objectives, or, well, in my opinion, their lack of, for the U.S. administration or Trump himself. He keeps changing them. Clearly, even if the Iranians or the Americans establish some kind of ceasefire or understanding, the Israelis are going to continue. And so from an investor perspective, from a market perspective, how should we interpret that? How should people interpret that? Is this just a continuation of an existing geopolitical shock, or is it much more of a structural thing?
Meaning if the U.S. stops and Israel continues?
Yeah, or versus if the United States continues with some kind of ground operation.
Well, again, it's all contingent upon what happens with energy prices here in the U.S. in particular, for the global economy and for the rest of the world too, of course. So it's anyone's guess how this proceeds. I think that, President Trump likes to talk off the cuff. I do think the objectives are there. Whether they're communicated properly or not, we'll see. But I do think that the fact that this didn't end as quickly as it might have in a few days was a bit of a surprise. The Strait of Hormuz being closed is a surprise. And these are, that's a critical waterway, of course. President Trump just announced an hour ago that Iran has agreed to no nuclear weapons, but I think that they had possibly agreed to that potentially before this conflict even started. But can you trust what they say? Right?
Absolutely. And so this brings me obviously to your main focus area, your expertise, which is during times of geopolitical uncertainty or heightened terrorism or just global shock events, gold is seen as a place of refuge, of safety. But why is gold falling despite the Iran war uncertainty?
Well, we've had a real big global liquidity sell-off with, speculators and investors not sure what's going to happen next, running to the sidelines, selling assets and raising cash, because you don't want to be holding a falling knife when you have an inflationary impulse that this war created 3 weeks ago, rippling through the markets and pushing market values down, which then started the snowball last Wednesday, Thursday, and Friday is really when the main action happened around the globe. Equities sold off sharply. The U.S., the Dow, the S&P, and the NASDAQ. Indices around the world sold off. Gold was selling off in sympathy to those. We had huge gains in gold and silver last year. Gold was up about 75% in 2025, and silver was up about 145%. So there's profits on the books there. And if you have to raise cash, or sometimes you just have to sell what you can, right, instead of what you want to. And gold is always liquid, and there's a lot of speculators in the precious metals markets at all times. So I call this a liquidity event where the precious metals are like the baby, but they end up getting thrown out with the dirty bathwater. And then after a few days, you realize, oh, we threw the baby out too. We've got to go get the baby back, for lack of a better way to put it. And we're seeing, some stability in all the markets now that President Trump said that we're going to hold off for 5 days on attacking the Iranian energy infrastructure. But again, that gives the U.S. Marines time to get there. And, there's speculation today in the U.S. that, if we get to that deadline and we still haven't come to where we want to be for a negotiated agreement, they could just push that out a bit further still. So we'll see whether that gets extended further or not, what really happens next, depending upon how Iran reacts, and who's even in charge over there now. We're not even sure who President Trump is actually talking to, although I think it's the leader of the Iranian parliament, but I'm not certain.
No, it's the it's supposedly meant to be Mojtaba Khaname, but he hasn't been seen nor made any vocal appearances. So, some people speculate, is he sort of like a vegetable in a coma?
Right.
Or is he just hiding away? But you would have thought he made an appearance by now for sort of psychological and I don't know, what's the word? Morale purposes. So certainly that there's speculation. The speaker is a bit of an odd character from my understanding, but yes, certainly it's causing even more havoc and uncertainty over sort of the duration of this conflict. But on that point, silver and gold did rebound on the taco sort of statement yesterday, but platinum's also been going down. So what are we seeing across the precious metals realm more broadly?
Well, gold is $4,400 an ounce today, US. Silver is just under $70 an ounce, which is about where they were a week ago before we had that real shellacking last week. Gold hit 4,100 on the low on would have been Sunday night, early Monday morning, New York time. Silver hit $61 on the low before the Trump announcement came Monday morning, before the markets opened. And we've rebounded back to where we were holding support primarily before last week's major sell-off occurred. Now, before that, gold was holding 5,000 pretty steadily, and silver was holding 80, 79, 80 pretty steadily. So we've given some up, but what we've also seen are treasury yields in the US spike substantially higher in the last 2 weeks, and last week in particular, with the 10-year treasury hitting 4.4%, up about 50 basis points since the war started, and the 2-year treasury yield up 80 basis points in the last 3 weeks since this, 3.5 weeks now since this war started. So we're seeing a bear flattening of the curve. We've got oil, close to $100 a barrel, and the 2-year treasury yield solidly over the federal funds rate by about 40 basis points right now. The last time we saw this configuration with a bear flattener, the 2-year treasury over the federal funds rate, and oil at $100 a barrel was in April and May of 2008, 3 or 4 or 5 months before the great financial crisis. And that's when there was stress over Bear Stearns in the spring of 2008, before Lehman Brothers fell in the fall of 2008, which precipitated the great financial crisis. But this is not a good sign, because the yields tend to lead the stock markets, and the stock markets tend to lead the economy. And yields are spiking and stocks have been falling. And precious metals have been caught up in that a bit. But if we get into a situation where the Fed in the US in particular really has to start to cut rates because the economy is slowing down, that's a recipe right now for real stagflation in the United States, with lower growth and higher yields that we've got already in the treasury markets, slower economy. So the US economy, I think, is due for a slowdown. Now, we were supposed to have a recession 2 years ago that everybody predicted that never happened. Maybe this will be the catalyst for some kind of a real economic slowdown, either in the US or globally will be hard to see, hard to tell right now. But that's the way markets are looking right now. And it depends on the duration of this conflict, how meaningful the energy infrastructure impairment really is. And we've already had some real damage done, right? The LNG plant in Qatar that produces about 18 to 20% of the world's LNG is offline for maybe a year or more. And there's been a major refinery in Bahrain that produces about 400 barrels of oil a day is now impaired too. And that's just a couple of the major ones, let alone some of the smaller problems that we've had as well. So duration of the conflict and the price of energy going forward, which I think will be higher for longer now because of that impairment, is going to eat into global economic activity. Eventually, this will be very good for precious metals, but until the volatility passes and there's some clearer direction, it's just going to be, we're going to be in choppy markets across the board.
Yeah, I just wanted to ask you on that point actually in a second, but one last question on gold specifically. So some people have suggested that gold could go to 10,000. Some market watchers, I saw a report in CNBC earlier talking about, forecasting of this being possible. What's your take on that?
That's pretty excessive in my opinion. I don't like to look too far over the horizon because things change, obviously. But fundamentals for gold have been very, very strong. I do think we got too far too fast last year, with gold going from about 2,800 to a high of 5,600 earlier this year, and silver going from under 40 all the way to 120 at the end of January. That's too much too fast. So we're in a consolidation phase for metals to start with. We've had a couple of those last year that were pretty shallow and short-lived. So I wouldn't be surprised to see gold chop and silver chop sideways for a few more months before we get a clearer direction. But I do think we'll start going higher. I think ultimately gold could easily be $6,500 to $7,000 an ounce in a year or two from now, depending on whether we really get a full-on economic slowdown. That really is the key to that, is whether the Fed's going to print money or not. If the Fed starts printing money to supplement a weaker U.S. economy, that is a recipe for substantially higher gold prices. And if that happens, $8,000 to $10,000 gold does come into play, but you've got to get interest rates down to zero first before the Fed will turn on the printing presses. That's typically the prerequisite, is lowering the Fed funds rate to zero. And even if they do that, inflation could rear its ugly head I really think the Fed's kind of neutered right now, to be honest with you, because the yields spiking are doing the Fed's work for them by slowing down the economy by raising borrowing costs. And it's more about where the yields are right now for the 10-year Treasury that matter more than what the Fed is doing. So we'll see. There's a lot of variables, and it just depends how they develop over time.
Certainly. I want to circle back to gold in due course, but firstly, on this inflation aspect, obviously, the main point I've been making is that it's one thing to have heightened prices or just heightened sort of market tensions, but that's not so much the problem as it is just the complete and utter unpredictability, the toing and froing, the volatility, the fluctuations is actually worse. So what do you think could happen if we continue this? Oil is at 115 and we wake up, it's under 100 again. The next day it's back over 120. Like, what impact do you think that is having?
Well, it's like we had tariffs on, off, high and low last year. The uncertainty that knee-jerking oil prices creates doesn't allow business to operate well. Those that are more energy contingent will be more affected. Like jet fuel's way up, diesel fuel is way up because the more refined gasoline derivative products are more costly to process, and that will affect the economy. I think more than people realize at this point in time, because things move by trucks and a lot of things are moved by airplanes. So the fuel costs will ripple through the economy in ways we don't expect. And if fertilizer is impaired coming out of the Middle East, when there's a lot of fertilizer that comes out of the Middle East, like there was out of the Ukraine prior to the Ukrainian war, I mean, that could impact food in 3 to 6 months, creating further inflationary pressures, which just means the printed currencies that we use, the dollar, the euro, the yen, will just buy less and less. So this is going to undermine the weaker parts of the economies of the world. And, the richer people, the more wealthy people that have wherewithal, they'll continue to survive this better, but it really could decimate a lot of the less income areas, both in the U.S. and around the world, making it harder for people to survive. So we'll see how it goes.
Yeah, I was having an interesting conversation with Frank Justra and some other sort of business-minded people in the past days. And, one of the things that I think there's not necessarily from you, but a bit of an understanding, appreciation of is that the war in Iran really does have more implications than the war in Ukraine in some ways, because whilst the war in Ukraine is heavily significant on its symbolism and the impact it has on international law and Europe and things like that, the overall absolute versus relative impact that Trump's war in Iran is having on markets, on the global south, is so much higher. So I'm just kind of curious where you see this going in the next couple of weeks, because just to add on to this rather long-winded, I promise there's a question in here, is simply in the 1970s, right? It makes me think of the 1970s stagnation. I just think we're entering a period of heightened stagnation, very little growth. You've hinted at the possibility of a recession. So talk me through, where you see this going.
Well, the main difference between the late 70s, when we were in a similar situation with a war in the Middle East and an oil shock, and we also had a crisis of confidence in the U.S. when our hostages were being held in Iran for 444 days. We don't have that crisis of confidence in the U.S. Right now in some ways, although there is a crisis of confidence in the U.S. around the world, which is part of why gold, was so high last year. But the difference is the debt. We had 35% debt to GDP in the late 70s. Today, we have about 110, 120% debt to GDP. So the costs of the war are going to increase the U.S. budget deficit, which is now, I think, 39 trillion. We just went over 39 trillion a couple of days ago. And our interest bill is now $1.5 trillion, which is more than we're spending on defense, although we're going to try and rectify that by spending more on defense this year, which just means greater deficits. We don't have the cushion economically to stomach a weaker economic period like we did in the 70s, but neither do we have the stomach to handle substantially higher Fed funds rates like Paul Volcker did in the late 70s to snuff inflation out when he raised the Fed funds rate to 15% when inflation hit 18%. If we get into that kind of a situation these days, we can't have it with our debt because the interest bill will skyrocket and it will literally crush the economy. So we're in a more resilient spot in some ways, but a more delicate spot financially as well. So I heard one analyst say that we might not get to stagflation, but we'll get to slowflation, where we get, just slower growth with higher inflation instead of a full-on bout of stagflation. And we're not as energy reliant now as we were at that point in time with gas guzzling cars and the energy consumption or energy production rather that we have in the US today. So it's a bit different situation from an energy perspective as well. We'll be insulated a bit from higher energy prices. WTI, West Texas Intermediate crude, is trading about $10 to $15 a barrel cheaper than Brent right now. So that's going to help us a bit, but it's still, this inflationary impulse is going to be bad for business, especially small business, which has stomached the economic closures that COVID brought on, then inflation, and then tariffs last year, and now this. I mean, small business here in the U.S. really absorbed quite a lot last year due to tariffs, and this higher cost input for energy, which could ripple through into other sectors, could be a bit more than we can handle at this point in time economically.
Yeah, there's a good question here from one of my audience members, and one that I had in my mind, which is that, gold has been having tailwinds due to sort of this de-dollarization movement or lessening dependence on US treasuries. I'm skeptical of the overall movement towards de-dollarization, but it's certainly happening in certain contexts like bilateral trade, using your local currencies, the Russians, Chinese increasingly doing this. How much further could this go?
Well, the trend is firmly in place, but it's a slow train coming, to kind of quote Bob Dylan. That's probably the biggest driver of gold's big gains last year was cumulative central bank buying, which started to really grow in earnest in 2022 after we weaponized the dollar when Russia invaded the Ukraine. Prior to 2022, between 2011 and 2021, central banks on average were buying about 500 tons of gold a year. They doubled that the last 4 years after we weaponized the dollar. That helped to turbocharge gold last year, plus a weaker dollar helped drive that move higher as well, because most of the gold that's bought around the world is priced in dollars, but it's bought in other currencies, which makes gold a little bit less expensive and a bit more attractive. But the trend is clearly in place. And I do think that the Trump tariffs last year caused enough uncertainty where just regular people around the world said, hey, what can I really trust right now? And gold was a big beneficiary of that. This is all still in place. None of that's changed. So I do think we're going to continue to see an erosion of the dollar's dominance in world trade, and gold will benefit by it. But the dollar is still not going to go anywhere in the long run, not anytime soon, because it's entrenched. It is the world's reserve currency for many reasons. There's really nothing to challenge it properly. One of the people that I've become friends with is a guy named Brent Johnson, who wrote the dollar milkshakes theory about 6 years ago, where when we have turmoil, the world goes to the dollar because it's a safe currency, often safer than their own currencies. He's recently come out with a paper that said stable coins may help to entrench the dollar around the world among people right now that have a hard time trading the dollar, where if we have a stable coin that you can trade the dollar right on your phone, and you're in Venezuela or Costa Rica or Thailand, and you're not happy with your currency, but it's hard for you to get out of it and into the dollar, if you can do it on your phone via a stable coin, that might help to cement the dollar status for a while longer as the world's reserve currency among a lot of little people, a lot of smaller investors. So that could help the dollar in the long run.
So you don't think or have much confidence? There's been this debate for a long time about BRICS plus. Iran's part of that, to keep this related to the situation with Iran. You don't believe in the idea of a common currency between sort of BRICS nations backed up by gold, as some people like to posit?
Well, they've supposedly backed the unit, which is their currency, 40% by gold, and that helps to explain why there's been so much central bank buying of gold, right? But gold is cumbersome to use as a settlement vehicle. I do think I fundamentally, since this argument came up, I've had a conflict in my own mind, and that is that China and India are two of the most populous countries. They're both BRICS nations. Neither one wants to cede the authority of their own central bank to the other. That's been my most fundamental internal argument in my mind against why a BRICS common currency will succeed in the long run. Because they don't trust each other fundamentally. They're necessary trading partners, but they have a lot of animosity towards each other. Now, how long did it take from the inception of the euro to the realization of the euro? 1979 to 1999, 20 years, right? Now, this could happen in the next 5, 10, 15 years, and I think longer rather than sooner, but I still think that we've got the dollar as the world's reserve currency for a while longer. And any country that has had the world's reserve currency, they don't give it up without a fight. And we certainly won't do that either. So I think that there's a chance for that to happen, but it's a ways off yet.
Yeah, I agree. I think it's a slow moving transition. You mentioned the euro. You know, obviously being European, I'm quite bullish on Europe from a sort of, well, normative standpoint. Pragmatically, there's a lot that has to be sorted out. But what's your idea of a scenario where the euro was sort of a partial reserve currency, depending upon if Europe federalizes? There's a growing movement for that because of Trump's treatment over Greenland and generally transatlantic relations. So do you think we could live in a scenario where there is a much stronger euro bonds, federal Europe competing with the Americans and giving that option to other countries, other players?
I'm probably not the best person to answer that question because the media that I get in the US isn't fair to what's really happening on the ground in Europe. So my information is probably not as good or near as good as yours with regard to that. So I humbly would like to take a pass on that one, if I may.
So we recently had Peter Schiff on the program, and as many people like to joke, he's very bullish on gold. And we counted at least 35 times within the first 20 minutes that he mentioned gold. I'm being slightly tongue-in-cheek there, but you know, he's obviously very confident in the role that gold plays in the future, regardless of what it is, and that we should just go back to gold as the primary sort of standpoint. Where do you sit on that, and where do you think things will go from here in the next sort of few years under Trump's term? I'm sure we'll have you back beforehand.
Well, the gold price being over $5,000 and rising so much last year is the world voting with its feet to, in a way, distrust the dollar a bit more and buy into something that's safer. So Peter does have a rational argument, and I'm acquaintances with Peter. We hang in the same circles, and I've spent some time with him. We joke that he's called 15 of the last 2 recessions because he tends to be a doomer sometimes, and he's very, very positive on gold. But he has been proven to be right in the last 2 years in particular. So in my head, in my thoughts, going back to a proper gold standard is impractical, because if we were to do that, it would put the gold price at 10, 15, maybe $20,000 an ounce to be able to do so. I think with the growth of an explosion of debt and currencies in the world in the last 25 years in particular, we've made it impractical to anchor our currency again with gold. A partial backing is possible. But I do think that gold will continue to benefit from the loss of purchasing power, which is the most fundamental driver of gold over time. Inflation, and gold has been tracking debt, which just keeps getting bigger on a global basis. Our debt in 2005 in the US was 7 trillion. It was 17 trillion in 2015. Now it's more than double that again. So it's doubled twice in the last 10 years. Will it double again in 2036 now to, almost 80 trillion? If that happens, having gold is a good thing, but I don't think it's going to be practical as a currency in the current world that we're in. I think we'll stable coins, or, I see Tether, is buying a lot of assets, tangible assets, and gold is one of them. I think they have about 12% of their assets are in gold right now, which is significant for a cryptocurrency, basically, or a stable coin. So I do see the world pushing towards gold, but not on a government level officially.
Okay, and I guess my final question for you is is there a risk that gold becomes overcrowded? If we're sitting here 12 months from now, what is that something, or is there another thing that markets might be underestimating right now?
Well, it's kind of ironic that out of every analyst's mouth last year in the US, especially in the second half of the year, was gold, 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 where they've ignored it like the redheaded stepchild that it's been for most of my 45 years in this business. I do think it'll continue to play a prominent role. I do think we will see higher prices. I'm sorry, could you ask your question again?
Well, I mean, I said, why is there a risk that gold becomes overcrowded?
Oh, overcrowded in the trade.
12 months from now, what is that something, or is there something else that markets are underestimating?
Well, we did get overcrowded. I do think that that's what helped push gold to 5,600. But, in the US, maybe 2% of the public owns gold. And we've seen fundamentally recommendations from major financial houses in the USA. The 60-40 stock to bond portfolio should now be 60-20-20, with 20% bonds and 20% gold. So until some of that is fully realized, I don't think that we will be overcrowded in the gold trade. Now, we got a little bit that way with speculators piling in, on a fear of missing out rally last January, just 2 months ago, which has helped bring the correction down. But I do think the appetite for gold will continue to grow as the debt in the world continues to grow. People that understand that fundamental equation will gravitate towards tangible things. And we've also seen other metals rise in the last year for the similar reasons, copper, lithium, the things that the world needs. There's been a kind of a land grab for them that was covert prior to last year that now kind of became overt this year. I mean, we've seen Samsung come up with a battery for EVs that's silver-based that can charge in 9 minutes and go 600 miles on a charge. They went directly to a Mexican silver mine last October with millions of dollars of investment to open a closed mine to go directly to the source to source silver. And I heard in December, 2 Canadian mines were approached by Canada to buy silver directly out of the ground at $7 or $8 per ounce over the spot price to secure a supply line. Gold is unique in that there's a lot of holdings of gold around the world for central banks. So there's a stockpile of it, but other minerals that are tangible have typically been underinvested in for decades now. And oil is part of that. And to ramp the manufacturing of these up is very commitment and cost intensive. You've got to make a big commitment for a long period of time to make more extraction of these minerals possible. And I do think the trend is in place to see all of these metals move higher. Uranium too, for reasons that this war in Iran is making obvious. We need more cheaper, efficient energy. We don't have uranium energy like France has, right? Great Britain doesn't have uranium energy, I don't believe, but small nuclear reactors are a wave of the future. I think that we need. I think that we can do them safely. But in any case, I don't think the gold trade it's certainly not crowded now. We've washed some of that overcrowding out, but I do think there would be a chance for that to occur again, depending on how all this, shakes out over time, especially if we see another wave of inflation that's sustained by this Iranian conflict and higher energy prices.
Well, that's quite a delicate note by which to end on for this episode. Thank you very much, Dana Samuelson of American Gold Exchange. It's been a pleasure hosting you. Everyone, if you aren't familiar, then do check out Dana's work. And also, of course, give the video a like. Do subscribe if you're listening to the audio. Do give it a rating. It really helps. And we'll see you all in the next episode. But thanks very much for watching and listening. Take care.